Welcome back to Global Equity Research, the podcast from Softgate Capital, where we break down complex equity stories into something you can actually use in your portfolio.
And today, we're doing something a little special. We're spotlighting one of the fastest-growing defense names in Europe, Czechoslovak Group, or CSG. This is a company that's gone from a regional industrial group to a top-tier European defense player in a remarkably short period of time.
Before we dive in, a quick word on who we are. Global Equity Research is powered by Softgate Capital Research. That's our independent research arm at Softgate Capital. If you want to go deeper than what we can cover in one episode, head over to softgatecapitalresearch.com. There you'll find full-length equity reports and macro pieces, written in an institutional style but priced for serious retail investors. So you don't need a big bank relationship to access granular, data-driven research.
Exactly. These aren't marketing brochures or flowery pitches. They're structured like what you'd expect on a buy-side desk. Company overviews, strategic positioning, detailed financials, valuation work, risk scenarios, and catalysts. CSG is one of the names we've recently covered in depth. Now, let's frame why we picked CSG for today. In January 2026, the company came to market on Euronext Amsterdam with a landmark initial public offering. It raised about 3.8 billion euros in gross proceeds, making it the largest defense sector IPO ever globally.
On day one, the stock jumped roughly 31%, closing at about €32.85 per share, versus the €25 offer price. Since then, it's pulled back. At the time of our report, we're looking at around €28.36 per share. But our target price sits at €40, which implies upside in the low 20s in percent terms from that level.
At that current price, you're talking about a market capitalization in the roughly €112 billion range, which instantly puts CSG among the most valuable, pure-play defense companies in Europe. It even surpassed some long-established local champions, including the traditional heavyweight on the Czech market. And under the surface, the growth profile is extraordinary. On a pro forma basis, CSG's revenue compounded at about 126% between 2022 and 2024. You don't see that kind of CAGR very often in this sector.
So the big idea for this episode is simple. CSG isn't just riding the defense supercycle, it's defining it. The question we're going to tackle is whether that makes the stock an attractive way to play Europe's rearmament, or whether the market is already pricing in most of the good news. Let's start with the basics. David, for listeners who haven't followed Central European industrial names, who or what is Czechoslovak Group today?
So CSG is a Prague-headquartered industrial and defense conglomerate, ultimately controlled by the Strnad family. It's built on the legacy of Czechoslovak heavy industry. Think ammunition plants, truck factories, engineering shops. But over the last decade, it has been aggressively consolidated into a unified group focused on defense. Operationally, they run 39 production facilities. Most of those are in the Czech Republic and Slovakia, but they now also own sites across Western Europe, in India, and in the United States. Through that network, they serve customers in more than 70 countries.
And in terms of what they actually make, we should emphasize the breadth, because this is key to the equity story. On one end, you have small and large caliber ammunition. On another, you have land systems like tactical trucks, armored vehicles, howitzer and rocket launcher systems. Then, layered on top, are defense electronics, radars, communications, command systems, and even aerospace components, especially small turbojet and turbofan engines for UAVs and missiles.
Right. And within that portfolio, CSG has acquired genuine market leadership. According to the company data we used, they are the #1 global producer of small-caliber ammunition by sales and the #2 producer of medium and large-caliber ammunition in Europe. Roughly speaking, they hold around 35% European market share in large munitions and about 13% of worldwide small arms ammunition. Those are big numbers in a supply-constrained market.
Another important dimension is who they sell to. Roughly 2/3 of CSG's sales are to NATO-aligned countries. If you look at the pro forma numbers for 2024 and the first 9 months of 2025, about 68% of revenues come from NATO members. Within that, Ukraine stands out. In the first 9 months of 2025, Ukraine alone represented 26% of CSG's total revenue, reflecting massive deliveries of ammunition and equipment tied to the war effort.
And that Ukraine exposure is a double-edged sword, which we'll come back to when we talk risk. But it has clearly been a growth accelerant. The other angle is the customer type. In the defense segment, about 79% of revenue comes directly from governments or from government-supervised contracts. Those contracts often have 3 to 6 year terms for ammunition supply and 5+ years for vehicle programs. That gives visibility, which, from an equity investor's perspective, supports the backlog story.
So, David, let me put a simple question to you that I think a lot of listeners will have. How did a Czech private group, with its roots in legacy industrial assets, become a top-tier European defense supplier in such a short period of time?
In our reading, there are 2 core drivers. First, timing and positioning. After 2014 and especially after 2022, European defense budgets started moving into what we call a supercycle. Stockpiles were deeply underfilled, particularly in artillery ammunition and basic land systems. CSG happened to be sitting on exactly the kind of capacity that could be scaled: ammunition lines, truck platforms, engineering talent, in a cost-competitive Central European setting. Second, execution and acquisitions. Management, led by Michal Strnad, moved very quickly to bolt-on capabilities. They acquired Fiocchi Munizioni in 2022 to deepen small-caliber ammunition. They brought in Tatra, the iconic Czech heavy truck maker, to anchor the land systems business. And in late 2024, they acquired the U.S. ammunition group Kinetic, think Remington and other brands, for around $2.2 billion. Those deals effectively transformed CSG from a regional player into a global ammunition and land systems platform in just a few years. So, when the war in Ukraine created a surge in demand, the group was one of the few entities in Europe that could credibly ramp up quickly.
And that combination, right assets, right time, plus aggressive M&A, is really the backbone of the CSG story we're going to unpack for the rest of the episode. Let's zoom in on the strategic engines of the business, because not all revenue streams here are created equal. If we start with ammunition, this is arguably the crown jewel, right?
Yes, ammunition is the core of the equity story. On the large caliber side, artillery shells, for example, CSG has around 35% share of the European market. On the small caliber side, the bullets you'd associate with small arms, they're at about 13% share globally. And importantly, this isn't just spot business. The company is locking in multi-year supply agreements. Typical contracts in this area run 3 to 6 years, and many are tied to national rearmament programs or multi-country EU and NATO initiatives to jointly procure artillery shells.
The Ukraine war was the catalyst for a huge scale-up. European stockpiles of artillery ammunition fell to something like 10% of desired levels, by some estimates, and CSG was one of the players that could physically add capacity. The combination of its Central European plants and the Fiocchi and Kinetic operations gave it a global footprint in ammo, just as that shortage became acute. From a margin perspective, ammo is also attractive because it's relatively less R&D heavy than, say, a fighter jet platform. Once your lines are certified, the economics are about throughput, cost control, and long-term contracts.
Exactly. That's a key reason why CSG's operating EBIT margins, around 24 to 25%, are above many European defense primes. Ammunition manufacturing at scale in a tight market tends to be margin accretive. Now, the second strategic engine is land systems and vehicles. Through Tatra and related businesses, CSG produces tactical trucks, armored vehicles, and rocket and howitzer systems. These are the platforms that move and protect ground forces, and they're critical as Europe replaces older Soviet-era fleets.
One data point we highlight in the report is a contract in 2025. CSG secured a deal worth over $1 billion for roughly 4,000 Tatra trucks for an Asian client. That's outside the core European theater and illustrates how the company is starting to export its land systems expertise to new regions. So you have ammo as the high-volume, high-margin consumable business, and trucks and vehicles as the more lumpy, program-based business, but both anchored in ground forces.
Then there's the third leg, defense electronics. CSG produces radars, communications equipment, and command and control systems. Those are typically integrated into wider defense architectures, often in partnership with other primes. It's a smaller portion of revenue versus ammunition and land systems, but strategically, it moves CSG up the value chain from being just a hardware and metal bending shop to being part of the digital nervous system of armed forces.
And finally, aerospace propulsion and related aerospace activities. Here we're talking about small turbojet and turbofan engines for unmanned aerial vehicles and for certain missile applications, plus avionics and other components. In 2023, about 63% of Aerospace Division sales were defense-related. CSG has also created units around UAVs. One example in our materials is the Avianera subsidiary focusing on unmanned systems. The strategic idea is clear. If you already make explosives and small jet engines, moving into guided munitions or loitering drones is a logical extension.
So if we step back, you have four interlocking pillars: ammunition, land systems, electronics, and aerospace propulsion. Together they let CSG offer integrated solutions. You can sell a country trucks, then the artillery systems to mount on them, the ammunition to fire, and potentially some of the sensors and drones that support those systems.
Let me push you a bit, David. If you had to pick one of those divisions as the one that will define CSG's next decade, ammo, vehicles, or aerospace, which would you choose?
Based on the current data, I'd still say ammunition. The backlog, the multi-year contracts, and the sheer shortage in NATO stocks suggest that this will remain the primary earnings engine for most of the decade. Land systems is a close second, especially as Eastern Europe replaces legacy fleets, and aerospace propulsion is more of an option on future growth as UAV demand evolves. But the important point for investors is that CSG is no longer just a one-product company. The diversification across these pillars helps smooth the cycle and gives management more levers to pull as defense budgets evolve.
Let's talk numbers. The headline is that CSG's financial trajectory over the last few years has been, frankly, explosive. Walk us through the key milestones.
Sure. Starting with 2022 to 2023, consolidated revenue went from roughly 1.01 billion euros to about 1.73 billion. That's a 71% increase year on year. EBITDA more than doubled to 439 million euros in 2023, which pushed the EBITDA margin to about 25.3%, up from around 19% in the prior year. Net profit increased 49%, reaching roughly 210 million euros.
So you have both top line and margin expansion, and that's before the really big acquisitions fully kick in.
Exactly. Financial momentum actually accelerated into 2024 and 2025. By the first 9 months of 2025, CSG had generated about 4.49 billion euros of revenue, which is an 82% year-on-year increase on a pro forma basis. Adjusted operating EBIT over those 9 months came in at around 1.10 billion euros, implying a margin of about 24.5%. So they're scaling fast, but maintaining very healthy profitability.
Management has indicated that full year 2025 revenues are expected to exceed 6.4 billion euros, which would represent nearly a 4 times increase versus 2023. And for 2026, guidance sits in the 7.4 to 7.6 billion euro range on the top line, with operating margins still in that 24 to 25% corridor. Importantly, those numbers aren't just wishful thinking. They're underpinned by an all-time high order backlog of around 14 billion euros as of the third quarter of 2025.
Right. And beyond the firm backlog, CSG has identified a pipeline of potential contracts of about 32 billion euros. Not all of that will convert, of course, but it gives you a sense of the opportunity set in front of them as European and allied defense budgets expand. On the balance sheet side, the rapid expansion and acquisition strategy has been funded with a mix of debt and, more recently, equity. As of September 2025, net debt was approximately €3.59 billion. That reflects the financing used for acquisitions like Fiocchi and Kinetic, as well as working capital to support inventory buildup.
The IPO brought in about €724 million of net proceeds to the company, which helps delever and gives them dry powder for future capacity and M&A. Despite the leverage, CSG picked up an investment-grade rating, BBB-, from Fitch in mid-2025, which validates the balance sheet in the eyes of credit markets. And we should underline how central M&A has been. Over the past 5 years, they've completed 5 major acquisitions, Fiocchi, Tatra, Kinetic, and others, that expanded both their geographic footprint and vertical integration.
Yes, one explicit rationale given for the IPO was to have listed equity as a currency for acquisitions. That's quite important. Rather than relying solely on debt, they can mix in stock for future deals, which is a typical tool for companies that want to keep consolidating an industry.
So let me ask what I think is on listeners' minds. Is this growth sustainable, or is it essentially a wartime anomaly? And how comfortable should investors be with this combination of high leverage and rapid M&A?
Our interpretation, based on the data we have, is that some deceleration is inevitable. You don't compound at 100+% forever. But the drivers aren't purely tied to active conflict. NATO allies have committed to significantly higher defense spending, with targets around 3.5% of GDP for core defense by 2035. Independent analyses suggest European defense budgets could grow at roughly 9% compound annually through 2030, which is faster than the global average. Within those budgets, ammunition, land systems, and associated ordnance, all CSG specialties, are expected to grow at double-digit rates as stockpiles are rebuilt and ground forces are modernized. On leverage and M&A, the risks are real. Net debt at around 2 times trailing EBITDA looks manageable, but the company still has to integrate operations across multiple countries and brands. Our base case is that they can handle it, but execution missteps, whether on quality, integration, or delivery, would be a key downside scenario.
So we're not saying the growth is costless or risk-free. But within the current European defense supercycle, CSG has positioned itself as one of the main beneficiaries, with both scale and margin strength. And the balance sheet looks acceptable for that strategy, at least based on today's numbers. Let's bring this together from an investor's point of view. We've got a hypergrowth defense name, strong margins, and a big backlog. How is the market valuing that, and how does it stack up against peers?
At the offer price of €25 per share, CSG was valued at around €25 billion of equity value and about $28.6 billion of enterprise value. On trailing numbers at that point, that worked out to roughly 17.5 times EV to EBITDA, a premium to the average European defense name. But that trailing multiple is somewhat misleading because earnings are still catching up with the order inflows. If you look forward to 2026 estimates, a Czech brokerage, Patria Finance, projected that CSG's EV to EBITDA multiple would drop below 14 times as EBITDA expands. At the post-IPO trading levels, around €32.85, and at the more recent level, around $28.36 that we use in our analysis, we're broadly in the 14 to 16 times EV to EBITDA range on 2026 earnings, by our own calculations.
In other words, not cheap, but not wildly out of line with global defense peers when you adjust for the growth profile. Many large defense primes trade in the mid-teens on forward EV to EBITDA. And if CSG can truly compound EBITDA at 60 to 80% between 2023 and 2025, then the EV to EBITDA to growth ratio, the PEG effectively, starts to look quite reasonable, even below 1. Another lens we use is EV to backlog. With around €28.6 billion of enterprise value at IPO and about $14 billion of firm backlog, the EV to backlog ratio is roughly 2 times. That means the market values each euro of current backlog at about 2 euros of enterprise value.
For context, some slower-growing defense primes can trade at EV to backlog ratios closer to 2 to 3 times, with much lower growth. So on that metric, CSG doesn't appear outlandish given its higher growth and strong margins. If we move to earnings, the trailing PE isn't particularly meaningful. On 2023 net income of around 210 million euros, the IPO PE was well over 100 times. But as revenue and margins scale, that compresses. Depending on where net margins stabilize, management aims for roughly 10 to 12%. You could see PE ratios dropping into the 30s on 2026 earnings.
Our blended valuation, combining peer multiple analysis and a discounted cash flow view, gives us a 12-month price target around 40 euros per share. That implies roughly 20 to 25% upside from the 28 euro handle, assuming the company executes on the backlog and hits its guidance. But to be clear, this is not a one-way bet. Let's talk about the main risks that we think investors should keep on their radar.
The first is demand risk tied to geopolitics. CSG has benefited enormously from the war in Ukraine. Ukraine represented about 26% of revenue in the first 9 months of 2025. A faster-than-expected peace settlement, or a sharp slowdown in emergency orders, could create an air pocket in demand before long-term NATO rearmament fully fills the gap. Second, budget and political risk. If economic pressures force governments to trim defense spending, or if the political mood turns more skeptical about high defense outlays, procurement could slow. This is particularly relevant in some Western European countries where domestic politics are fluid. Third, execution risk. CSG is scaling from a mid-sized regional group to a multi-billion-euro global enterprise in a few years. Integrating acquisitions like Fiocchi and Kinetic, maintaining quality control across continents, ramping output without errors. All of that is non-trivial. A significant quality issue or delivery failure could damage both reputation and margins.
There's also governance and ownership. Post-IPO, founder and chairman Michal Sternad still owns roughly 85% of the company. That means minority shareholders are effectively along for the ride with a controlling owner. While that can align long-term incentives, it also raises questions about float, liquidity, and potential related party or capital allocation decisions. And finally, concentration in defense. Around 79% of CSG's revenue is defense-related. Only about 19% is civil, and even some of that is dual use. If the defense cycle were to turn, a large portion of the business would be directly exposed.
On the flip side, there are meaningful catalysts. One is continued earnings outperformance. If quarterly results show that CSG is converting backlog into revenue faster than expected, while preserving mid-20s margins, the market could re-rate the stock. Another is major contract wins. The company is in the running for several sizable programs, from EU or NATO joint ammunition procurements to further Asian vehicle deals. Any new multi-billion euro order would be a clear signal that the order book can keep replenishing.
We also flag M&A and partnerships as potential upside. With a listed currency and a higher profile, CSG could strike joint ventures with large Western primes or acquire niche technology players in drones, electronics, or advanced munitions. Successful moves up the value chain, for example into guided or smart munitions leveraging their propulsion know-how, could expand the addressable market and support higher multiples. And down the line, management has signaled an intention to start paying dividends, targeting a 30 to 40% payout ratio of net profit from 2027 onwards. That shift toward a more cash-generative, shareholder-friendly profile could broaden the investor base.
So how do we synthesize all this? In our view, CSG is a rare combination: scale, hypergrowth, and high margins in a sector with unusually strong multi-year visibility. It's not without risk, particularly around geopolitics and execution. But if the company delivers on its backlog and manages its balance sheet prudently, there is room for both earnings growth and some multiple support.
For investors looking for exposure to Europe's defense renaissance, CSG stands out as a high beta but fundamentally robust way to play that theme. It's not a sleepy, utility-like defense name. It's a dynamic consolidator sitting in the middle of the ammunition and land systems bottleneck. Or, to borrow the line from our report, CSG isn't just another defense contractor. It's Europe's fastest-scaling munitions and land systems powerhouse, and its trajectory is only beginning.
If you want to dig into the charts, segment breakdowns, and scenario analysis behind everything we've discussed today, you can find the full CSG report, along with our other equity and macro research, at softgatecapitalresearch.com. Emily, thanks for walking through this one with me.
Always a pleasure. And thanks to all of you for listening to Global Equity Research. We'll be back soon with another deep dive into the companies and themes shaping global markets.
Until then, stay informed, stay curious, and we'll talk to you in the next episode.